and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and policy impact. I'm Govindraj, Ethiraj. The economy might be reeling from the after effects of demonetization and a general global slowdown, but India's stock markets are buzzing away. The Sensex has now touched a near 6-month high around 29,892, with all-time highs near now, particularly for the Nifty, now at 8,939. The question we are asking is, what is driving the markets to such strong levels? And more importantly, can this run continue for a while? And finally, could this be the best time to speed up disinvestments of public sector units? To discuss all of this, I'm joined by Sudeep Bandapadhyay, Chairman of IndiTrade Capital, and Ashish Kyal of Waves Strategy Advisors. Thank you both, gentlemen, for joining me. Sudeep, let me begin with you. So, what's driving this?
Well, I think, Govind, two things. One is the liquidity. There is enough and more liquidity sitting in the system, both internationally as well as domestically. People are looking at equity markets seriously because of this liquidity. The second thing I would say is that globally, if you see, the equity markets have been doing well once again. And the entire emerging markets, PAC has performed very well. Look at Brazil, they've gone up about 20%. Some of the emerging markets have done even better than India. India did, as you rightly said, got a hit in the market post demonetization, and we have caught on. But I think still there is some way to go.
So we recovered 13%, as I understand, from the demonetization loss, and 9% just in 2017.
That's right. That's right. So I think the question is, emerging markets are flavor of the season. There is enough and more liquidity. India, people realize that we are, irrespective of the estimate, we will clock between 6.5% to 7.5% GDP growth, which is great in today's context. So I think money is coming to India. The second thing I would say, corporate performance, the way we were envisaging when the demonetization happened, it wasn't so bad. Yeah, some results were bad, but by and large, whatever was the expectation, the corporate performance has been much better than that. So I think that gives the confidence to the investors to come back to the market and buy with vengeance.
So are you saying this in some ways is a continuation of a secular trend?
Absolutely.
Or a sort of more powerful relief rally because of lesser than expected impact of demonetization?
Two things. I think it's a combination of both, Govind. One is, it is definitely a kind of a relief rally, and second is a continuation of trend, both. Because continuation of trend, because markets globally have been going up.
Right.
So I think that trend remains. Second, Indian corporate performance has been much better than what was expected. So it's kind of a reaffirmation of the faith of the investors in Indian capital market, Indian corporates.
And particularly the markets. Okay. Ashish, just your first thoughts on what's really driving the kind of performance we're seeing in the stock markets, particularly in the last few months?
Govind, the overall trend of the markets have been positive for around the rally started in March, and from March onwards we have seen a continuous higher and a higher low. So the overall trend has been positive from March onwards, from the very low levels of 6825. So the rally which has started from 6825 is still continuing, and lately what we have seen is the participation is seen from those sectors and stocks that were a major laggards. Now, one classic example right now is Reliance Industries. Now, everyone has been seeing the way Reliance Industries performed drastically in previous sessions, where it was up by nearly 10 to 12% in a single day. It's not very often that we see a stock like Reliance Industries going up by that much in a single day. So that and the other broader markets were taking a halt then. So what is happening is, this rally is a rotational rally where a specific stock or a specific sector performs well, which is helping index to move higher. So the overall sign is still healthy very much. And one sector that I would like to point out is probably an IT sector. It has been a very, very strong outperformer over past few weeks, and it has happened on the back of negative news that has been flowing all around. May it be Infosys or TCS, there has been a lot of negative news right from US as well as the internal corporate governance issue. Despite of all those things, market are discounting that there will be good times ahead, and that's why IT stocks have been rallying. So what is driving this rally has been a rotational sector. So initially it was PSU banks, then now PSU banks have taken a halt. They are probably relieving their overbought zone, and now the flavor looks like an IT sector and probably Reliance, which is now going to drive the markets over next few weeks or months.
Right, Ashish, thanks for that. So, if you look at the index heavyweights that have been driving this, so Ashish spoke about IT, and we're also seeing buybacks in IT, and we're also seeing telecom consolidation. So are these some of the specific facts that are driving some of these big stocks and therefore the index? And
in fact, Govind, somebody was mentioning we have a new hero every day in the capital markets. So it's been happening. Sometimes some Pharma company got their FDA clearance. Sometime, as you said, IT, there is some buybacks and are getting announced. Reliance, of course, came with the Geo plan, which market was not expecting. So we are having newer and newer heroes, and these are all large companies. So I think that has been a boon for the market. So I think, when the market is in a mood to spend money and invest, and you get some of these good news in the market, obviously it helps the cause of the rally.
Right. So just to come back to the point that you were making earlier, liquidity.
That's
so,
right.
In general, foreign institutional investors have been selling,
That's
while
right.
domestic investors, particularly through mutual funds, have been investing. How does it stand today, and what's really driving the market more amongst these two?
I think, it's a mix. You look at the HDFC Bank incidents. In a single day, within few hours, the foreign institutional investors poured in almost $2 billion. So, not $1.5 billion they poured in. So, I think the money is there and available with the foreign investors as well. So, they are ready to pour in money if there is a good cause. Domestic investors, of course, have been sitting in the sidelines for a very long time, and they have been investing with a vengeance. Look at what happened in Reliance. I think pretty much all the large funds, both domestic as well as international, were not having adequate reliance. So the moment it turned around, I think there was a scramble yesterday which we saw for Reliance.
Okay.
So I think both are there, liquidity is there, they will keep buying.
Right. Okay. So, Ashish, where does this take valuations? I mean, a lot of investors obviously get attracted by these levels, and we mentioned this in the beginning. We are very close to lifetime highs now, since the Nifty particularly, which is barely at 8939 right now, and the peak was 9003.
From the valuations perspective, I think it's not very cheap market as of now. Even Nifty PE has been at the higher levels from the average that we have seen around 17 or 18. So it's not very cheap market. So in this kind of a market, I think it's going to be a stock specific rally which is going to continue. The movement, Govind, which we saw in 2003 to 2008 was very, very different, where majority of the markets, majority of the stocks were participating. But in the current rally, which we are seeing over past few months, it has been a very, very rotational one. So it is a very typical and a peculiar rally that we are seeing. On the other hand, there has been a strong global movement that we are seeing. Dow Jones have been all over the places. It has continued to rise even after Trump coming into power. So, which was a major surprise for the world markets again. So, the rally is not localized. It has been a global rally. It has been a phenomenal rally across the globe. And I think India is now trying to catch up with that. So, valuations, even if it becomes expensive, it's going to be irrational for some time, I suppose. And then the corporate earnings might catch up. The companies might start showing good returns despite of all the demonetization which has happened. If the corporate earnings start picking up again, then the valuations will automatically come down.
Okay, right. So, and the big question then is that how does this become an opportunity, particularly, let's say, for the government, which is looking at a lot of IPOs, it is looking at disinvesting. What's the best time to do it then, and how?
Well, I think it's a great opportunity. I think normally we find the government coming with all these disinvestments at a time where markets are not supportive. Now, the kind of liquidity we have in the market, investors are looking for good opportunities to invest money. If in these circumstances, government can come up with disinvestments, both strategic as well as IPOs, I think it will be a great opportunity for the government to get in a good amount of money through this source.
And what is the kind of window do you think they have now to do this?
Well, I think it's very, very difficult, Govind, to say. The market mood has to be right. Today, the market mood is right. So the government
But for IPOs as well? I mean, secondary might be good.
Absolutely.
But, yeah.
But I'll tell you something, IPO normally from start to finish takes a lot of time.
Yes.
So I would say the government has to be opportunistic. This is an opportunity in front of you. So go ahead and start, doing OFS. Start doing, a strategic sale. I think that's a great opportunity. If you're planning to do some strategic sale, why not now? OFSs, it doesn't take time. Just do it.
Okay, great. So, Ashish, last word. What's your sense? How could this be an opportunity? Is this the right time to push ahead with a bunch of IPOs, particularly from the government's table?
Absolutely, there is no second thought going. The market sentiments have been extremely positive right now. The mood has been positive. We can look at what happened to the IPO of BSE. It was subscribed exponentially well. So during the bull run, when the markets are in a good mood, you will see a huge subscriptions which happens from the investors, and the listing also happens extremely well. So most of the IPOs that have been listed over past few months have done pretty good on the listing day at least. So I think it's the right time that government can start planning out very soon to probably divest the stake what they want to do. That will help them to raise money, reduce the deficit, and it's definitely going to help pump in money within the economy, which is again going to generate jobs and employment. So we are in a very, very conducive stage as of now. Markets are very dynamic. I mean, it might change the direction in just a month's time and suddenly something comes up. So we need to be acting fast and quick, so before the market changes its mood.
Thank you very much, Ashish. Thank you, Sudeep, for joining me. We need to go in for a break. Coming up on the other side, why is the infrastructure getting down-rated? We speak to KK Mohanty, Managing Director of Gammon Infra, and Chintan Lakhani, Associate Director, Infrastructure Ratings at India Ratings. Stay with us.
St. Thomas Basilica. One of the world's 3 churches that is built over the Tomb of Apostles. St. Thomas was one of the 12 apostles of Jesus Christ who brought Christianity to India. With an underground tomb where the remains of St. Thomas are laid, this magnificent basilica is of Gothic architecture. The stained glass of the church depicts some divine moments of St. Thomas's life. In 2006, this church was conferred with the status of National Shrine.
Welcome back to Policy Watch. Ratings agency India Ratings has maintained a negative outlook on the infrastructure sector for the coming financial year. The outlook includes roads and power, critical inputs to the overall economic growth story. Now, the larger question now is, how is India's infrastructure sector likely to shape up, particularly given the union budget's almost 4 lakh crore rupee push? Will this push help resolve some of the problems of both roads and power, many of which are stuck for various reasons? Is there sufficient capital to meet the needs of many infrastructure projects? And what are the challenges and issues that have to be addressed in the near term? To discuss this, I'm joined by KK Mohanty, Managing Director of Gammon Infra, and Chintan Lakhani, Associate Director, Infrastructure Ratings for India Ratings. Thank you both for joining me. Mr. Mohanty, let me begin with you. The last time we spoke was before the union budget. At that time, we did not know what kind of push the budget was going to give to the infrastructure sector. We have a number now, 4 lakh crores, that of course includes railways. So what's your sense? Is enough being done, or has enough been done, at least from a budgetary point of view?
If you look at the budgetary provisions, these provisions are mainly targeted at the last mile of the economy of India, means towards the rural areas and the less developed areas, into states and other areas. So that directly is not going to impact might be the so-called big construction or infrastructure houses in the country. Today, in spite of that, there is enough scope for the infrastructure sector to grow. But the challenge today is due to the legacy or the baggage being carried by both the bad accounts and the poor financial condition of infrastructure industry, and the lack of convergence in the public sector or the government sector in delivering the policy decisions or the initiatives taken, is today, honestly speaking, is not translating into any tangible result, and still the feel-good factor is not coming, the actual numbers are not improving, and at the grassroots level things are not happening, because today there is no convergence between, for example, all the stakeholders like the lenders, the investors, the construction companies, the bureaucracy and the regulators. And even the rating agents to some extent are not converging in seeing that the whole objective is delivered. So even if the government has shown lot of flexibility in taking policy initiatives, relaxed few things, showing sincere intent and interest to really get going in the infrastructure sector, because the banking sector and especially the financial health of most of the infrastructure companies are not in a sound situation, is affecting the whole delivery system.
When you say all these various constituencies are not in convergence, can you give us an example to illustrate that?
For example, Today, suppose take the example of first some of the operational projects where the revenue is not good enough to sustain the project. So there are two types of steps being taken. One is some type of like the SDR or a S4 RBI guideline is there. Debt funds are there to reduce the interest burden on the project. And finally might be one-time settlements also being done by the banks to see that the projects are on their on the auto mode. But if you look at a small issue there, all the debt funds are coming and trying to source business. When they go to a rating agency, for a rating, debt funds require a rating agency a DSCR of 1.6. If you understand what means by 1.6 DSCR, it means you have 60% higher cash flow than the required cash flow, so that you can service the loan. If the projects are so good, then why they will go to a debt fund and to a reduction of interest and so many things. So unless the rating agency and the debt funds and the policy guideline of RBI come to a convergence on this, naturally the steps taken by debt funds or any other initiative taken by the government to bail out these projects is not going to work. So we are into a standstill position. If there is a 1.6 DSCR, the existing lenders and bankers will be happy with the project. Why they will look for an alternative at all?
Okay, hold your thought there. So let me bring you in, Chandan. So, roads and thermal power is what you've identified as problem areas. How bad is it in roads? And, if you can just walk us through what we've achieved so far in terms of wanting to set right distressed projects and where we are headed today.
See, what has happened in the recent past is there have been numerous policy actions like 100% exit for the sponsors. There have been improvements in traffic, but that has been in patches. So a lot of road stretches that we've seen, the ramp-up period has been much more elongated than what you would expect. In fact, our analysis even suggests that the more mature projects, and when I say mature, I mean say more than 3 or 4 years of operational history, the resilience of cash flows for downside movements in traffic is slightly better. So even if you see a 6 to 7% year-on-year revenue growth, they would still be able to have a debt service about 1.3. Mr. Mohanty mentioned about 1.6 DSCR. Maybe he's talking about the average DSCR, but if you look at it from a debt servicing ability, rating agencies also emphasize on the minimum debt service coverage ratio, which in most of the matured assets has not been higher than about 1.4x. Coming to the power projects.
So what does that mean?
That means that even though in some of the years the resilience for mature assets, the debt servicing is still higher, but in our base case projections, even if you take an 8 to 10% year-on-year growth rate, they would still be about the ramp-up projects. So when I say ramp-up projects, I mean less than 3 years of operational history. The DSCR, minimum DSCR in any of the years during the loan tenure would be around say 1.1, 1.2, which gives you very, very less cushion. So even a 2% dip in the revenue expectations could actually impair the debt service ability of that entity.
Correct, the ability to pay back loans. No, so let's take a step back. You're talking about projects which have already rolled out, as in people, traffic is moving, they're paying tolls, and we're talking about how they're paying back their loans. What about the ones which are still stuck? I mean, what's your prognosis there?
Again, there also, on the road projects, the land acquisition issues to a large extent kind of remain because 80% of the land needs to be there for them to get started. We also saw a surge in the HAM projects which are being awarded the hybrid annuity model and a dip in the BOT projects, of course. But even on the ground action, if you see on the projects that have not been operational or have been awarded also, the financial closure for HAM projects has also been much on the slower side. There's much spoken about. In fact, we are also upbeat in terms of the execution of the HAM projects because the funding risks, the traffic risk have been removed from the sponsor. For power projects, the problems kind of continue to remain the same because there has been sluggish demand. The supply growth has been slightly over and above what the demand growth would have been. There are no long-term PPA takers, especially because of fragile finances of the discoms. One brighter spot in the coal-based thermal power projects could be the availability of coal and less dependence on imported coal. And of course, the cost for an e-auction coal or an imported coal has been slightly higher, but the dependence has also been much slightly lower than last year. So that is a slightly brighter spot. But the problems in terms of land acquisition, in terms of the long-term PPAs not being executed, the finances of the discoms, which in turn is having an impact on the receivable position for the power supplier, that continues to remain.
So more broadly, would you say that then the legacy problems of roads and power largely continue to continue, or the whole overhang continues?
We would put it this way, that yes, they do kind of remain in terms of, say, a traffic. Traffic has always been an issue in roads. We've been talking about it since time immemorial. So that kind of remains. But what is happening from a road project perspective, there are a lot of refinance transactions also happening. So there are innovative models which are coming in. There are InvITs that are being talked about, where we are even seeing sponsors talking about 50% of the debt reduced. Of course, all these InvITs are likely to hit the primary market in the next couple of months or so. So the realization that actual implementation of that happening is one thing. Traffic continues to be a problem, but refinance transactions are happening. So we see entry of private equity funds.
So you're saying when you say traffic continues to be a problem, how short is it in terms of the expectation?
Anywhere between 8 to 20% or so on a broad level.
Is below
what we expect, and even not even in our expectations, but from a debt serviceability as well. I was mentioning about the private equity guys coming in, they are refinancing the loans also. We've seen some instances where even after the refinancing, that debt has been reduced. So they realized that the debt which was there held by the earlier promoter was not commensurate with what the project could withstand, the cash flows would withstand. So they've come in, reduce the debt either in form of quasi equity or subordinate debt, so that the pressure on the banks have kind of reduced. And of course, we spoke about InvITs also, so that is one thing. On the power projects also, there's a lot of trust being given to the renewables as well. So the coal-based thermal power projects are even increasingly facing competition from renewables as well.
Okay, yeah, that's something that you mentioned in the report. So, Mr. Mohanty, let me come back to you. So, if you were to look ahead now, let's say for the next year or two, what's your own order book looking like? What are the shifts that you're seeing? What are the legacy challenges that you're carrying with you?
See, first and foremost is when you talk about these deals in the market, whether PE or the 100% exit, compared to the market size and a vast country like India, the deals are far and few. So we cannot really count on them to survive in a country like ours and such a big economic size. The second thing is, before answering your question, I must mention that this 3 lakhs, 4 lakhs crores worth of whatever infrastructure provision has been done might be that towards aiming at the last mile into the rural or semi-urban areas, where there will be a new creation of new infrastructure, small companies which will be mushrooming into the small towns and rural areas, where that might slightly boost up the economy in those areas. But if you look at the big bang, the bigger companies who are looking at the bigger projects, technologically driven, and they have the expertise to implement bigger projects and technically complicated projects, if that needs to happen in a large scale, naturally somewhere a corrective measure has to be taken, especially the past legacy and the hangover of the bad accounts, the projects not earning money. The basic reason today remains is the infrastructure companies are not making money. If they do not make money in the business, naturally investors, lenders, everybody will run away. And for that, today the primary reason requirement is the governance issue and correcting the past baggage or the legacy, which is really a hangover on all the infrastructure companies.
Okay, so let's talk about another challenge, which is prospective, and that's capital. What's your sense? Are you seeing that more the finance minister last year talked about $1.5 trillion required for India's infrastructure gap. What's your sense in terms of what we've raised, what we're likely to raise, government's own contribution, private sector's capability to fill the gap?
Most of our cases, the sponsors, the infrastructure sponsors that we've seen, the ability has kind of deteriorated over the last couple of years. So even when we mentioned the ability, it's not about the equity infusion which is required to complete the project in the first place. There's also increased dependence because the projects are underperforming from what we had expected when they were during the implementation stage. So that dependence on the sponsors is also increasing, because apart from the equity commitment, they have to come in to bridge the cost overruns also, if there are any O&M cost overruns also. There are reserves that are we saw the demonetization happening where the tolls were suspended. So a lot of our sub-investment grade projects were more dependent on the sponsors because the reserves were wiped out. In terms of the actual capital flow, of course the bank lending has been kind of much on the lower side. We've seen reduced on a year-on-year basis. If we see FY16 numbers also, it's been much lower than about 60% or so from FY15 levels as well.
So and what's 17 looking like?
17 also, we feel that bank lending might continue to be kind of a dampener over there. But we need to see something like in which we mentioned there are innovative models which are coming in. There are investors which are echoing. Of course, you could always question at what yield they are coming and what is the yield expectations going to be there. So that we'll have to actually wait and watch as to what yield those are expected to come.
Right. We're running out of time. Mr. Mohanty, last word. Your outlook for the coming year. I mean, are there any bright spots that you're seeing in despite all of this?
Though the potential is too high today in the country like India, we cannot be too optimistic with our experience of last 3-4 years. So we need to wait and watch, and with a hope that the things will streamline, but it will take little time. I'm very sure the present experience says the way the governance is there, unless there is a drastic intervention required to converge all the stakeholders in this industry, and governments take some very specific and decisive decision to correct the past legacy, I think it will not be a fast pickup. It will slowly grow, but it will take some time.
Right, Mr. Mohanty, thank you so much. And that's all we've got time for this edition of Policy Watch. We'll be back next week, same time. Thanks for watching.